Mr. Chen, welcome to our program.
Glad to be with you.
Saturday morning, we see the State Council held a press conference introducing a package of new fiscal policies. What's your take on that?
The Chinese government has been rolling out a series of stimulus plans. Up to this point, most of these plans are on the monetary side. We know that only monetary stimulus at this point is not sufficient. One is clearly there are all indicators showing that the aggregate domestic demand is weak. A lot of sectors, especially corporate sectors, are in debt. Also, a lot of families, households, their willingness to increase consumption looks like need a boost. Essentially, when you lower interest rate, you make borrowing money more cheaper. But that's still debt. The central government of China financially remains the strongest among large economies. We are seeing the beginning of a series of fiscal plans. We will see more details. The most important reason we could do this is because the Chinese central government, they have very low levels of debt. It's very likely that the central government will issue more what we call super long-term bonds, and the proceeds of that will be used to solve debt problems in local governments, other problems in the real estate sector, and used directly to boost consumption of households.
China's Asian market has set new records. Multiple foreign asset managers have upgraded China stocks to overweight.
Sure.
Did you expect it coming?
The reason why global institutions like Goldman Sachs is now saying they are overweighing the Chinese equity markets, you can't just look at the Chinese side. You have to look at the US side as well. I mean, over the last few years, the best performing assets of any kind, no doubt, is the Magnificent Seven. And they're now worth $16 trillion, which is much larger than stock markets from other countries combined. We actually discussed this topic at the forum. Professor Franklin Allen actually made a very interesting observation that it is quite likely the US tech company, Magnificent Seven so-called, are way overvalued relative to Chinese and Indian tech companies. So the point is that you look at these US tech companies, there's not much room for them to grow. Very likely at some point there's going to be a correction. On the other hand, valuation-wise, when we look at the Chinese equity market, the Chinese tech firms listed in Hong Kong, their valuation is really, really low compared to US. And then if you look at the Asia market, in addition to tech, some other sectors like consumption durables, their valuation is also very low. Since the end of last year, the global investors are returning to Shanghai. We talked to a lot of these US investors. They range from investors of these mutual funds, investors from university endowments, investors from sovereign funds. So the reason they came back is they know they should look at China. It seems that a lot of the investors are waiting for some signals. And as soon as these stimulus plans are coming, and they're coming meeting or exceeding the expectation of investors, that's when you see the markets, especially like the stock market, which is very sensitive to these information. I mean, it's very volatile, and obviously we need to get used to that over the next few months. But clearly the trend is that you have seen a very strong rebounding. And that includes capital from North America, from Europe, from all over the world.
Do you think this trend, this rally, will be a long-term one?
When you look at the broad China equity market, it's A-share and it's Hong Kong. If you look at the Hong Kong Stock Exchange, almost all of the large China tech or tech-based companies are listed in Hong Kong. The point about these companies is, in general, their fundamental remains strong. I do expect the Hong Kong market, this rebound will last 4 weeks. So if you look at the A-share market, if you look at a longer horizon, like 5 years or longer, the sector that's done reasonably well is consumer durables. Also energy. For these sectors, again, if your fundamental is strong, we should expect the rally to continue. If the rally can last longer, one important thing is you want to see very different movement on the prices of different firms, right? And this is very important. So if you look at September 24th and 25th, there's not much difference. Everybody's going up. right? But after the national holiday break, you do see differences. You could see that one sector does really well. In the same trading day, some other sectors actually had a bad day. When you see, when you have 2 red days followed by 1 green day, so adjustment along the rally is also not a bad thing.
And the previous rallies in the Asian market turns out kind of short. Is this round of rally different from the previous ones?
It is different. Obviously the most recent one, the ones that most investors still remember very vividly, is the 2014, 2015, right? It's the rally and then drop, crash. So it is different from that in a sense that the economic condition, the industry condition now versus that time is quite different. 2, I think this time people should feel more confident about the rally lasting longer is precisely because the market, the regulators, and the investors themselves still have very vivid memory of what happened in 2014, 2015. As you can see that the regulators are already putting out notices restricting borrow money to trade because we had experience lessons from the previous rally and drops. The other thing I think it's quite different is that obviously the market is waiting for the stimulus. The stimulus has come. The effect of the stimulus, whether it's monetary or fiscal, they're not realized over a day or a week. So we need to be patient, and that's also important. But I think by now, especially after this press conference from Ministry of Finance, I think there's no doubt that the Chinese government, the central government, is determined to roll out a sequence of stimulus plans. I'm sure if needed, there will be more to come.
The US Federal Reserve is now lowering its interest rates. How do you think that will impact the global market, specifically the Chinese market? Will it kind of bring some impact to China's stock market, China's capital market?
The past few years, the interest rate levels in the US have been very high. I mean, they have a different set of problems. But the fact that the US interest rates are very high, that's actually a big problem for all emerging markets, including China. The annual return, the effective return on holding a dollar bond is more than 4.5%. That's actually very high. Because the US interest rate level is so high, that actually puts some constraints on the Chinese monetary policy because we need to stimulate. The effective interest rate level in China and the US, there was a gap. So now clearly they have entered into a different cycle. They are lowering interest rate. Very important for emerging markets like China, the interest rate in the US lower means we now have more room to stimulate the Chinese economy by lowering our interest rate. So I think in net, that's good for China. And a final point to that is on the monetary side, the first in a series of conferences happened in September 24, and the US Fed cut interest rate for the first time in 12 meetings. That happened in September 18. So that's not surprising, that's good timing. Once we know for a fact the Fed is cutting rates, and they're cutting rates perhaps more than expectation, they cut by 50 points. This is the window of opportunity for China to step in and announce plans that have been made already, but we're waiting for this window of opportunity to announce it.
Mr. Chen, thanks for your time.
You're welcome.